It is the WealthVest Bull&Bear podcast. It is November 12th. We are joined by one of our favorite repeat guests, and David Cervantes of Pine Brook Macro. David, how are you?
Good. Thanks for having me. Good to see you, and Drew as well.
So I mentioned you'd been on the podcast before. I don't remember when you first came on the podcast, you having the following that you do now. I kind of feel like I knew you when, right? I mean, you have really blown up on Substack, and Substack is such a great platform, and there's so much good content on there. It is a hell of an accomplishment to stand out in that crowd. And so I just want to start a little bit by asking you the easiest question you've been ever asked. Why do you think you've had so much success on Substack? What is it about your content that you think is resonating so well with people?
I think first of all, the long form platform is a help. Before I was doing a lot of tweeting, long form tweets, threads on Twitter. That just gets hard to manage. At one point, they had a long time ago, at least, they had limits on how long a thread could be. And I think Substack as a platform itself allows, for narrative long form content to be put out there. And the community is growing. Obviously, Twitter's, evolved. Some people have liked it, some people have not. So there's been some migration shift of for users to consume content from Twitter onto Substack. Most importantly, I'd say, I've had a lot of support, not just from followers and subscribers, but also just mentors and people like yourself who have, given me a platform and given me an audience to broadcast my message. So appreciate you guys, appreciate everyone I've worked with. And I've gotten lucky with some of the evolving with the market. That's, you can't dismiss. You make your own luck, but luck also has to go in your favor. And so that's worked out well. I think in terms of a differentiating factor has been kind of my approach to macro, which I think the traditional macro analysis has been very indicator based. So it's like, oh, well, if XYZ indicator is doing this, ISM is doing that, then, if A, then B. And I think that was kind of on the way out for a while, but I think the pandemic really just shot that whole framework in the head.
Those historical correlations, right? If when LEI does this, the SOM rule, all of these different rules that worked historically that haven't worked now.
Yeah. So the big one was obviously the yield curve inversion that was gospel since forever, 3 decades at least, and that's one of them. The other one was housing. 7 out of 11 post-war recessions have originated in the housing market, and when housing has been in the dumps since 2022, and we still haven't had a recession. It's crazy. I mean, you would have figured that kind of track record, housing would have pulled the economy into a recession. It hasn't happened. And I think a lot of that is just the gargantuan flood of money, and the whole policy package, response package to the pandemic. I think it's just a force of nature, so to speak, that overwhelmed everything. It's just like when you've got that much money pumped in, we're talking World War II, size stimulus packages. We have an accommodative monetary authority, the central bank. Even though they're raising rates, they still prioritize the labor market while doing so. And they were aggressive at first, but I'd had to Jay Powell and soft landing. So far, nothing's. We're in a soft landing mode. So I think getting back to this kind of coordinated approach to policymaking really just threw the old bag of tricks out the window. We needed a new script, and I was fortunate enough to kind of catch that and evolve with that script in real time. I myself was, when I started tweeting, I was for sure, the yield curves inverted, we're screwed. The housing market, holy cow, we're screwed. And then as I watched the data evolve, like, wow, actually, we got screwed. Why is that? And it was really just kind of a function of asking questions, allowing in my head for two opposite things can coexist at the same time. Just kind of reconciling frameworks and approaches where, like, you know what, you can have an inverted yield curve and not be in a recession. You know what, you can have, this or that happen. You can have the housing market, in fact, be in the toilet and not be in a recession. And I think it was really just kind of coming at peace with, hey, it's that whole playbook is out the door. It was really um, an imaginary iterative process. Really, it's almost art as opposed to science, and
Yeah.
that's a whole nother argument. But that's the way I approached it, and I was able to evolve my thinking in real time with the market. I think the clever um, insight was just kind of just don't fight the market, don't fight the
Right.
data. You know, listen to the data, listen to what the market's telling you. It's
Right.
smarter than you.
Yeah. Yeah. And there are firsts, right? I mean, this is an economy that doesn't look like other economies. Look, we are, I don't know what the right GDP number is, but it's positive. Is it 1%? Is it 3.9%? As the Atlanta Fed says, it's a positive number. And yet we are not creating jobs, right? That is a whole new world. We have fiscal spending that is unlike any time in history. As you say, we have World War II like deficits at a time of relatively full employment. And you have a Fed that, as you say, is really accommodative. Like if you told me that the last CPI print was going to be 3 and the Fed was going to be cutting rates and signaling more cuts, I would have said, no, I don't think you're right about that. But you do have to listen to the market. You're right. And you look at what demand looks like. Consumer demand has held up just fine, despite the fact that, as you say, we've had real slack in the housing market. And yet nothing's happened. It's an interesting housing market though, because it's totally unlike '07, '08, right? Because you don't have mass unemployment coming out of the housing sector. Housing new starts have come way, way down, and yet housing employment is still really, really strong because I think on the remodel side, you still have entities that can't find labor.
Yeah, and but you mentioned labor. I want to segue a little bit. You mentioned labor now, and also before an economy that's not, creating a whole lot of new jobs, if any at all. How are we not in a recession? And that's another crazy dynamic that I've been writing about for over a year in my Substack, which is the shrinking labor market, right?
Yeah.
So the immigration policies of both Biden, which were pro-immigration, which increased people inflows into the country. So in 2022, 2023, you had this booming NFP numbers, but the unemployment rate was slowly rising, and that was because just the arithmetic relationship with growth in the population. You had more people, so more people looking for jobs. And then now we kind of, with Trump, we have the opposite of that, where you know people are terrified of coming in here. They'll end up in some detention center, deported, or God forbid,
Yeah.
El Salvador, where that place is.
Yeah.
So that has shrunk. The immigrant was the marginal add to the labor market, just because, one, our birth rates are slowly declining, and two, well, even if we have kids today, they're not going to enter the workforce for at least 18, 20 years. So the immigrant was the marginal add to the labor force in real time, right? So with that stopping, the labor force is shrinking at the margin. So that means that even though the economy is producing less jobs, we still have a stable employment number. It's obviously moving, but it's not. You would think that with, earlier this year we were, in the six figures. Now I think the latest projection for the October NFP is something on the order of negative 50,000 jobs per Goldman Sachs. So how is it that unemployment hasn't fallen apart? The labor market's not falling apart, and therefore we're still in an expansion despite low job creation. So these kinds of um, very interesting phenomena, being able to kind of catch them has allowed me to not really freak out about a NFP, we're going into recession. That's it. It's over. Nope, it's not over. The music hasn't stopped, and it's not going to stop for a while. But the approach needs to be kind of very holistic, where you're looking at things like, immigration policy, labor market shrinkage, et cetera, et cetera.
Yeah. Well, you and I mused about this on Twitter earlier this week about, you know, the labor supply is shrinking because of zero immigration or perhaps even negative immigration. And then you have aging demographics, people my age and older leaving the labor force. You have a skills mismatch, right? Where you have 9% unemployment for 20 to 24-year-olds because they don't necessarily have the skills that employers are looking for, but that immigrants create demand as well as supply, and I think that's a concept that people struggle with.
Yeah, and excuse me. So I do see consumption is slowing for that reason, for that exact reason. Is that right? People that regardless of their legal status, they are people. They need to buy things to stay alive. They need to buy food. They need shelter. They need transportation. Regardless of the price point at which they consume these things, they still need these things. So when you have kind of a negative demand hit as a result of the negative supply hit, that will shrink consumption, which will likely shrink the rate of the expansion later in the future. We're missing a lot of data, so it's going to be very hard for me to say how that maps out right now. But I think that needs to be appreciated, that less people coming in means less people buying things.
Sure, sure. Well, why don't we talk a little bit about your 2026 outlook, and just kind of what are the important factors that you're looking for, and your sense of what's gonna matter here as we enter the new year.
Yeah, so that's interesting, right? I think let's go back to what the current narrative is. The current narrative is that we're in an AI-driven bubble, that it's the only thing driving GDP. The only area creating jobs, and it's kind of this whole edifice is resting on a very narrow, weak, shaky foundation. And the other part too is that now we were seeing, where a lot of the AI build was free cash flow funded. Now we're seeing bond issuance, whether it's on balance sheet or off balance sheet, like what Meta is doing, to fund the AI build out. So now it's making people even more crazy, more neurotic about, oh my God, it's over. So obviously bubbles are hard to spot in real time. Whether the AI build itself is gonna collapse, if or when, that's above my pay grade. But I will tell you, the price action in the market doesn't reflect a bubble. So, for example, off the top of my head, I don't have the numbers, but the Nasdaq from 19 from January 99 through October 99, I believe did something like 37%.
Right.
And then in the following 2 months did another 24%, and then did another 27%. Again, I actually have this written down in my Substack.
Yeah. No.
But the bottom line is, in 14 months, now this number is correct. In 14 months, the Nasdaq did 130%.
Right.
Right. In the past 14 months, the Nasdaq's done, or the Nasdaq 100 rather, QQQs, they've done a sad but respectable 32%.
Right.
So maybe from a gross capital allocation macroeconomic view, it's kind of an overspend on AI, but the market is not drinking the Kool-Aid. The market is saying, it's assigning, that's the appreciation it's assigning, 32% in 14 months versus 130% in
Right.
the dot-com bubble. So
Right.
we're not even close to that. If you want to see a bubble, and then people say, well, it's, the valuation multiple, right now we're at 22.3, I think, whatever, 22, right? We tagged 23 with .com, but I think what people forget is valuation is really if you go back to the Keynesian beauty contest analogy, where it's kind of valuation is in the eye of the beholder, right? Just like beauty. So it's what do you want, what's this worth to you? Well, it's worth to me, I'll pay for it. It's sentiment driven ultimately. I mean, there's some utility value, but so what is it that reinforces sentiment? It's really the macroeconomic environment. And we basically have a policy apparatus that has said, you know what, we're not going to allow recessions.
We're running it hot.
It's just not going to happen. You even forget running it hot. There is a floor to how low this thing will go, whether it's, the Fed or whether it's talking with Trump. It's, no one wants to cross that red line. No one thinks the trade-off is worth it. And so whether we run it hot or not, the market knows that there is a floor. So what does that do? That creates a stable environment for projections. A low volatility environment allows you to, if you're a firm, capital X spending, if you're a consumer, and you buy a house, or I know housing is kind of probably a third rail in this conversation, but what other consumption patterns, vacations or whatever, you can think about when that your job is mostly secure, that you can make these decisions. So we have a macro environment that is supported by an accommodative policy apparatus. We have a decline in volatility. That means a decline in risk premiums. That means that, companies can plan, and that gives investors a sense of confidence in what they're willing to bid for, a stream of cash flows for assets. So I think that's not appreciated. Before 1999, I mean, I was around, you were around, Drew, I don't know about you, but, I was definitely around. And, it was a good time, but there was a much, much greater geopolitical, kind of, I don't know. It just seems like right now it's Pax Americana, and the U.S. has no military diplomatic peer, right? I mean, it's China, but honestly, until it happens, it's a theoretical. And for all practical intents and purposes, we have no peer competitor.
Sure.
Right. So that, there were still some questions back in 1999. Even we won the Cold War. China still wasn't where it was, but I just feel like now, that's just not. We have no peer competitor. We are the apex nation, and I think there's just policymaking has gotten better. There's been a lot of hard lessons learned. There's always overreach, but after the global financial crisis, the regulatory framework really kind of shot that boom bust cycle of housing in the head. Where every 3 to 4 years you'd have a housing bust, recession. That kind of got neutered. Now, I mean, now we have there's some, you can make the argument there's been some overreach, but we there's that. I think policymakers has gotten a lot better. We understand that recessions have huge social costs and costs that are not immediately, don't immediately show up in the marketplace. Things like, social things like, divorce rates, suicide rates, family formation rates, all these really kind of not great things happen during recessions. And we learned that with, the Great Recession, the post, the global financial crisis, that recovery was extremely slow and extremely painful. That's what, I think a lot of the populist angst that's going on right now has at least some roots in that.
The big difference between now and then is that we don't give a shit about inflation anymore. I mean, you say policy, I'm not trying to be argumentative, but you say policy making is getting better. But in a sense, haven't we created a moral hazard? Haven't we created, first of all, a much higher inflationary policy? Remember Obama, Paul Krugman was the only one who is, considered a socialist, for God's sakes, by some. He was the only one saying that Obama should spend a hell of a lot more than $1 trillion. And we spent it, and there was no inflation. And then now we get to 2022 and post the pandemic, and it's like, hey, inflation's dead, so let's just print, because inflation ain't ever coming back. And lo and behold, look what we have. We have some inflation. So, like, I don't know. There are the Austrians out there who are listening to this conversation going, wait a minute, recession's bad? No, recessions are necessary.
Yeah, and one of the interesting things maybe is it's probably changed consumer investor behavior too, right? I was just reading an Economist article. We have 39% of equities in America are owned by people who are 70 and up. Normally they'd be de-risking, but the last 15 years has seemed like radically altered what would be a traditional investor behavior if you're 70 or 80 years old.
Yeah, that's a good point.
Yeah, no, so go back to inflation, yeah, there's no doubt that, for now at least three is the new two, right? 3% as a policy target. I mean, no one's gonna say it,
Yeah.
God forbid. But effectively three has become the new two. And I think it is a new regime where the labor market is being prioritized over inflation. For now, that's being seen as the lesser evil. Now, I think that's changing. I think with the recent election, I think inflation is really, really front and center. And I think people are getting fed up. With this, I know the cost on paper, the cost of the inflation rate on food has really come down, right? But people don't care about rates; they care about levels, right? How much of your paycheck is going to food, and that hasn't. We might have less inflation, but it's still at a high level.
Yeah.
Right. And same thing with shelter. Shelter right now is kind of borderline disinflation. Not there yet, but the rate of shelter appreciation has really come back.
Sure.
But people are saying, yeah, still got to pay my rent that I locked in 23 or 24 2-year lease, and it hurts. And so I think there is that push to get back to 2% is going to be top of mind for policymakers now. I think the wild card. We were making really good progress there, and then the Liberation Day tariffs. I think right before Liberation, we were at, I believe, 2.4. Could be wrong, but there's no doubt that we got an inflationary impulse. Everyone's pointing. It's Trump's economy now. Can't say it's Biden's economy anymore, and Trump is going to take some heat, and they did. And the question is, how with the labor market shrinking, consumption in the aggregate slowing down, how much room is there to remain restrictive? Right now, the odds for a December cut, policy rate cut, have fallen, kind of slowly coming up. We got Steve Mirren saying we should cut 50. I don't think that's likely, but yeah, I expect that chorus to get louder. But for now, three is the new two, and it's not without its trade-offs, negative ones, and that's I think that angst that we're kind of getting now.
Yeah, it really is interesting how this plays out. Rick Reeder, who is on the list of potential next Fed chair, he had a comment yesterday that kind of blew me away. He said, "I don't think three is problematic." So the person, well, what's problematic? He said, "Yeah, 4 to 5." Really?
Oh wow,
4 to 5? So
wow.
I don't know. It will be interesting to the degree that I'm old enough that I remember high inflation in the early 80s, and my dad was a beer distributor in Memphis, Tennessee, and he was borrowing money at 20%, leasing trucks, and the only thing he cared about in the election in 1980 for Carter and Reagan was interest rates. And, I go back to all this because there was a time where Republicans won on the idea of fiscal restraint, and that fiscal restraint would beget and stronger monetary policy would beget lower inflation. It will be interesting if we get there again and you have Democrats and Republicans running in 2026 on, hey, we should hold the Fed to their 2% target, and we should cut fiscal spending so as to lower the rate of inflation. Now, it's a very tough thing for politicians to come out and say, by the way, I can never lower prices, because if we get into deflation, you're really not going to like that. The best I can offer is a slower rate of change. That isn't the most compelling political story to tell.
Yeah, no, it's not. I mean, nobody likes, especially seniors who are politically powerful, and they've paid into the system, right? It's like, wait a minute, I did what I was told. Now give me what's my due, right? Whether it's Social Security, whether it's healthcare or whatever, there's that. So that's gonna be a tough political fight. Just want to kind of segue back into what 2026 is
Yeah.
looking like. I mentioned it's not a bubble.
Yeah.
I can't give it all away, so I'm working on this note actually, but preview to the next note I'm working on is, how what's the math behind next year's price targets? And I'm not making a price target forecast. What I'm saying is this is where we are. This is what earnings are. This is what it's going to take to move the dial, move the needle, and get us to whatever appreciation. So right now, 2025 earnings roughly 270. That's pretty much baking the cake with given where we are on the calendar. And then we're looking at 306 roughly. So now that's a 13% increase in earnings. And we're at a 22 multiple, do the math, and then if you say, well, what if we actually grow earnings at 15 or 20%? What does that do for us? And it doesn't do a whole lot. I think to really move the dial on next year, we're going to have bubble-like equity multiple expansion. In other words, you're going to need to really get into the double-digit returns for the S&P 500 next year. You're going to really need that multiple to go to at least 24. And if you want to get into the 20s, you're going to have to hit 26 PE, which would be really, really, that would be unprecedented. That would be unprecedented.
And crazy unprecedented on a CAPE basis, right?
Oh, for sure. Even worse. But so that's something I'm still working my way through that.
Yeah.
But the numbers, I'm trying to think, how do we get to a 26 PE? And then you kind of take apart the S&P 500 to the different sectors, and then you look at, well, PE, what's the multiple on the current multiple on tech. XL, you can use XLK as a proxy. It's roughly 31. But to really start moving the needle, if let's say for example, if tech alone were to be the only catalyst that drives it, then you're going to need the tech multiple to go from 31 to 37 to get you to a 42, to get you to 24 S&P 500 PE.
Mm-hmm.
And if you really want to get to a 26 aggregate S&P 500 PE, you're going to need around 41 or 42 multiple on the tech sector. That's roughly 30% expansion in multiple for that to happen. Now, so that goes back to the AI and the bubble. Is it a bubble then? I don't know, but can it happen? I think that is a serious multiple expansions. And now you get into the game of what's the probability of it. And I don't know the answer to that question, but that's the way how I'm framing my 2026 outlook is we're going to have to get some serious multiple expansion. So let's say it doesn't happen in tech. Let's say it happens everywhere else. You're going to need, I haven't finished working through it, but I know to get to 24, if you keep tech constant, you're going to need around 10% average multiple expansion, everything else, X tech, to get to 24. And I think it's around 15%, maybe 17% to get to 26. So what are the chances of all these, some of these other sectors that have underperformed getting that? I don't know, but that's kind of the hurdle we're looking at. That's how I'm framing 2026. I'm not,
Yeah.
I think, go ahead.
Go ahead. But it makes me think about how Dan Niles thinks about these things. And I know he's got some haters. I think he's one of the best analysts I've ever known. He had one of the greatest calls I ever knew in 2003, 2004, pounding the table on semis. And I told him that. He remembered that well. I actually remember when the presentation he gave, but I digress. His thing is basically, if people get more bullish on the productivity potential of AI across the economy, then multiples can expand. If people get more pessimistic on the productivity benefit to AI, multiples will contract. And I think one thing we've seen to your case of, hey, multiples can still expand is I never thought margins could continue to expand amid such a slow nominal growth economy, right? I mean, we only have somewhere in the neighborhood of 4 to 5% nominal growth. If you don't have margin expansion, then earnings growth is only going to be, excluding buybacks, is only going to be 4 to 5%, maybe 6, 7% with buybacks. So how do you keep getting 12, 13, 14, 15% earnings growth? It's margin expansion and it's productivity.
So yeah, and I actually did a really long note on that last year. I plan on updating, but there's basically, the core question was, how do we get, let me back up. The post GFC productivity level was the lowest in post-war history. I think it was like 1.3% annual. And now, and productivity is hard to measure. What is productivity, right? I mean, we have to, we know what it means, but it's kind of like, you know, how do you see it in the forest, right?
Yeah,
How do you
it's
know?
very hard to predict, right? Most
Right.
economists will tell you they can't predict productivity.
And right now, all indications are that we're kind of in the middle of this productivity boom. We are above 2%, right? And there are three ways to keep that going, if not grow that. And one is, and this goes back to the Fed, one is the labor market. Well, if you're able, there, I mentioned these social costs to recessions and kind of a employment extinction event. One of the one of the economic costs of recessions is people, they when they lose a job and they stay on the job market, their skills atrophy. And we all know, we all have that story of someone we know or someone we've heard of that lost a job, couldn't get back in the workforce. And after a certain time, you get a stigma. And, after a certain time, you're kind of really shut out of the labor market. You
Yep.
either need to find something else to do or take a drastic reduction in pay and in prestige, right?
Yep.
So we know that happens with recessions. So by maintaining full employment, we know the opposite. By staying in the workforce, your skill set continues to grow. It continues to evolve with technology and new processes and new tools and blah 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 blah. So we know that there is a benefit to keeping people at work. I know there's the argument of, well, the deadwood, but all else being equal, broadly speaking, there is a net positive to the economy in maintaining a full labor force. Um, but and again, I want to qualify that a full labor force via competitive means, not a full labor force like a welfare jobs program. That's obviously, we all know that, we all know how that goes. But if you're able to maintain full employment in a competitive labor market, then that is a real productivity booster in the aggregate. And we haven't excuse me, we haven't had that kind of labor market since the 90s. That was kind of really the peak of the labor market after the early 60s. And then the other thing is supply chains, abundance versus scarcity, right? The big thing was always oil and petrol. And we're kind of moving away from that as an industrialized economy. And despite the supply chain hiccups that we've had since the pandemic, and then now with tariffs, we still maintain relative abundance of supplies. There's no, if you want something, you can get it. Pay enough for it, but you can get it. I'm kind of having the brain fart right now with the third element. It's in my notes. It's in my Substack, published last year in December. But the bottom line is, we are macro wise, we are set up to continue productivity expansion.
Yeah. I think the thing that you recognized and you wrote about it either early last year or even 2023 is that concept of the continuity of employment. When people are in their jobs for a long period of time, when groups of people are in their jobs, they work well together and they become more productive. And that in interruption to that and periods of of unemployment spikes and so forth have deleterious long-term effects on productivity. So I do think that recognizing that productivity potential of a long-term tight labor market was one of the great kind of epiphanies that I had from reading your work last year. And I think that was something that you were loud about, right? You believed in that concept, and you really deserve some credit because it was not something that I read anywhere else.
Thanks. I mean, it was really, I was trying to understand what could move the needle, and it was really margins, right? So as you mentioned, the nominal GDP growth slowing with inflation slowing. Now we got a shrinking labor market, and all these things point towards less bottom line. But if you could expand the margin through productivity, which everything kind of points that's happening, then you have the basis of an optimistic outlook for saying, hey, we can increase margins and it'll flow to the bottom line, and yeah, we can get to potentially 24, 25, or even 26. It really comes down to I think we need to discard the, oh my God, we hit 23 in .com, it's over, the music's going to stop. I think again, going back to the indicator analysis, the multiple is just another indicator. And I think we need to kind of disabuse ourselves of being slaves to the shiny toy model and saying, okay, why is 23 the top? Why was that? And then look at what are the causal factors of the 23? What are the causal factors that would contribute to a 24, 25, 26? And all roads lead to productivity.
Mm-hmm.
And so far, that's what we're seeing. So I do think that we're at kind of like everyone was saying soft landing possible. It's never happened. The Fed's always over tightened. And I think a lot of people are looking at this in the same fashion of like 23. Oh, that's it. It's never happened. Where it's like threading a fire hose through a needle. And I think it is threading a fire hose through a needle, but it can be done.
Yeah.
If with the right set of policies and some luck. I mean, Jesus, we can't if you get a bad negative shock, and Liberation Day could have been that shock. We were on the precipice of entering that shock until Trump tacoed. We were on the precipice of throwing it all away. It was tragic to see in real time, but look, at least we came back, got walked back from that edge, but there's still a potential for other shocks that can derail all that.
Speaking of shocks,
go ahead, Drew.
I was just curious, if our question we've talked about the last couple of weeks, and I'd love to hear your thoughts, is if the Supreme Court invalidates these tariffs, do you think that is a temporary boost to the stock market, or do you think the alternative can happen if people are worried that, hey, the bond market's going to get away from us, and then we had $200 billion of revenue that has to get sent back?
So, I mean, that's priced, right? The market's smart. The bond market knows that there's a very high probability that these things get struck down. There's also a high probability that some refunds come out. Equally, though, there's a high probability Trump being Trump. Let's just be honest with who we're dealing with. He's not one to back down. He's not. He might check it out, but I think from there it's what else they have pulled out from my bag of tricks to do this, and he does actually have a lot of other alternatives to this that he can use. So I think there's a lot of uncertainty. So if the Supreme Court does strike these things down, I don't think it's an automatic refund.
Yeah,
I think it could be one of these things like, well, we're gonna wait and see because we're gonna try these other avenues and call this set of tariffs this and call this other set of tariffs that, but net we keep the money. And that we don't know is the answer. But I think that's the way I'm approaching it. And the market knows this, and it seems like that's the way the market is approaching it too. If a $2 trillion blank check refund was in the offing, I think rates would not be where they are now. They'd be higher.
Yeah. I think you're right. I mean, I think people have looked at this and said, look, the IEEPA may be struck down, but that doesn't strike down 232. It doesn't strike down the steel and aluminum tariffs. It doesn't strike down 308. He's got other options. And there's also just the very real possibility that he kind of takes the Andrew Jackson approach and says, Marshall has made his ruling, let him enforce it. Like, he's going to continue to do what he wants to do. And that might scare some people from a constitutional point of view, from an authoritarian point of view, but the market has not given a damn about, any kind of long-term risks to American democracy. It just hasn't.
No, yeah, I actually wrote about that back in April. I wrote another the dollar, but so after Liberation Day, the dollar started trending down. And there was this kind of wide, this consensus narrative going around that, holy cow, that's it. The dollar's days are numbered, and that's just, for better or worse. It's there is no alternative. What other market can absorb capital flows on the scale that we can? There's just no one else can do it. And on top of that, warts and all, it's still the better legal and regulatory structure as there is. So I think capital for the American exceptional trade, one that I championed earlier. um I think the American exceptionalism trade will still has a lot more runway than I have in this life.
Yeah, I mean, I think that's something that people should appreciate about you, that your experience is very much differentiated than most forecasters out there, and that your background is in emerging markets. So you've seen, what happens when you don't have good rule of law around assets, and why money flows to the United States, to jurisdictions like the United States. And as you say, there really is no alternative. The only pushback I would have to that, and I don't have an alternative, but just, do you worry about, from a dollar perspective and a money flows perspective, we do have essentially a weak dollar policy. So I know this word debasement gets thrown around a lot, but I do think this administration would like to continue to see the dollar weaken. If you care about trade deficits, the only way to really fix trade deficits is through currency adjustments. So when you're overall sanguine on 2026, we're not in a bubble. Margins can continue to go higher. There's no rule that says productivity can't go higher. But what is debasement or weak dollar something that worries you, or not really, because of what you just said from a TINA perspective?
Honestly, it doesn't worry me at all. It doesn't keep me up at night. I think what concerns me more is the fiscal situation, which it is kind of related to the dollar. But I think we do need to get our fiscal house in order. And I'm usually not a panicking over the fiscal situation, but now these, ever since the I think the policy, the big money policy response to the pandemic was the right one. It was the correct one, but we haven't put the Kool-Aid down, or the punch bowl. Where everyone's still at the trough. I mean, these deficits are still gargantuan. Now I think the interest on the federal budget is larger than the defense budget, which was the single biggest line item before. And so we've kind of crossed into that territory that, for at least for emerging markets, when your interest is your biggest line item, if we didn't have reserve dollar, reserve status, I think it would be lights out, or at least the start of lights out. We have, because of our dollar status, reserve currency status, we do have more runway. But now there is some kind of an end to that horizon. That horizon event is coming into play, though, where that just becomes exponential. And I think if Trump really wants to go out on top, I think I think that should be his next initiative, is getting spending under, like, real spending, and not this Doge nonsense that or Dodge, whatever they called it. Not this nonsense, not the performative nonsense that says, hey, we're laying people off and just kind of stupidly going about it. I think a real, it comes down to entitlement reform. That's it. If Trump can take on entitlement reform, I think he could go out really on top.
So let's say we're now running somewhere in the neighborhood of, depending on what happens with the tariffs, somewhere in the neighborhood of 6.5% deficits as a percentage of GDP. The 3-3-3 plan put forward by Scott Bessent, which was, we're going to have 3% budget deficits. We will grow. We'll have 3% GDP growth, which we have, and we'll have 3 million barrels of extra oil production, which of course has not happened. But if we go to 3% deficits, do you think we could avoid a recession? Or do you think you'd immediately have a recession if you had that much of a fiscal drag year over year?
I mean, I think I think from 6 to 3 in one fiscal year or calendar year, I think that'd be a shock to the economy, and that would be recessionary, I think. Yeah. Mm-hmm. Now, how it's done and over what time frame is really what matters.
Sure.
And shift. Ultimately, it is one big pot. It's really, macro, I like to call political economy and drag. So it's really, how do we settle our distributive conflicts? Who gets what and at what price?
Right.
That's really what it comes down to. So we'll have to say to, seniors, okay, what you're getting is going to be less because we got to allocate some of that to this. And we play this game of musical chairs, slowly eliminating a chair at a time, so to speak, to shrink those deficits. But it's got to be done, I think, thoughtfully over time. And I do think an adjustment of that size in 1 year, that would be recessionary. There's no doubt about it.
Right. Do you worry, just as we look at the 2026 outlook, we were talking about earnings, do you worry about earnings quality? The big gap between reported and GAAP, the big gap between earnings and free cash flow, all of the talk about so much of the earnings contribution is from the Mag 7, and we're not going to get into a really painful accounting discussion of depreciation, but there are plenty of very smart guys out there who make the argument that, 23 times is not the right number. We're really much higher than that if you look at it on a normalized gap between GAAP and reported earnings, and that really earnings are overstated. If you look at the market multiple on a free cash flow basis, you're back to really above the 2020, the 2000 period.
I think that really speaks to a broader philosophical discussion. Do you think markets are efficient? I think they do. I think they are. So markets know this. They know the difference, and they can distinguish between, whether it's GAAP or pro forma, or whether depreciation schedules. The market knows this. This is nothing new. So I'd like to think that the market is much smarter than I am, much smarter than Michael Burry. Much smarter than all of us, and the market knows this. So I think it's more. I think it's really one of these things where it's a narrative chasing a price, and if and when the AI trade unwinds, whether it's in a spectacular supernova pop or just kind of slowly bleeds out, I think then that's going to invite the causal narrative discussion. But as of now, the market doesn't care.
Right. Yeah, the market reflects the growth, the productivity. And you made a really good comment that I thought the other day, and it reminds me of what our old friend George Robertson has talked about, where, like the 10-year is going to reflect nominal growth, right? The 10-year is not going to go much, much higher if the expectation is that nominal growth is going to go down and vice versa. And right now, the market is telling you that growth is kind of somewhat steady state. The bond market is telling you that growth is somewhat steady state.
Yeah, I mean, I think a lot of people look at the 10-year, and they look at spot rates and say, oh my God, if there's a big divergence between that. What the 10-year is an average of 10 years, not just one single year. So we can have nominal GDP be X, and the yield of the 10-year, the nominal yield of the 10-year be Y, and be different. And that's because the 10-year factors in 10 years of inflation, 10 years of real growth, 10 years of nominal growth, and blends them together into an average. And that's what we have. And so, the current, I think it's 4.07 or 4.08 as of this morning. Right now, the 10-year note, the bond market is telling us that's roughly, when you smooth it all together, what we're going to see.
Yeah. Yeah. A favorite asset class you'd be willing to discuss on 2026, or that's giving away the preview?
That's giving away the preview.
All right. Can I ask you your thoughts just quickly, because of your background in emerging markets, how you see Argentina and the swap line kind of playing out from here? Do you think that they continue to pull down on that swap line, and ultimately that currency has to find a clearing price?
So the answer is they're going to continue to draw on that swap line until they can accumulate reserves internally. So their dilemma is they are short dollars. They owe the IMF roughly $430 billion. and they have coupon and principal paying, interest and principal payments to make on a regular basis, just like everyone else does for their own debts.
Yeah.
They got to make those in dollars. So if they don't have the dollars, then they're in a potential default situation. What they're doing is they're allowing, what a strong dollar helps the government do is keep inflation under control. Because it's really weird. They're a partially dollarized economy. I don't know if a lot of people know this, but the U.S. dollar is legal tender in Argentina. So you have kind of this parallel dual currency market, and it's legal. It's not just like it just happens. It's actually sanctioned by the government. So you have this, people can settle debts in dollars or Argentine pesos. If the government starts to pull dollars out of the private market and into its own coffers or coffers, I don't know what it is, but into its own balance sheet, then you're forcing everything back into to be done in pesos, which is inflationary. So that no one that currency has lost a lot of confidence. So Milei is running a kind of a he's running a balancing act of trying to keep inflation under control, and still meet the credit the debtor obligations to their creditor, the IMF.
Yeah.
So that's kind of where things sit. And he will continue to use that until they reverse that policy and accumulate dollars. Now, the only way they can really do that is through depreciation.
Yeah.
That's kind of what they're, but again, a depreciation would be, or devaluation, I'm sorry. A devaluation would be highly inflationary. So that's what they're looking at. For now, it's a tightrope. They claim that they're going to gradually, they got this peg and they're going to widen the band on the currency peg to try to slowly kind of have a manage depreciation. What they don't want is a overnight shock where, things get cut in half. That would just be a disaster. They're trying to really kind of have a slow depreciation that doesn't wreck the economy overnight. So it's really a question of rates, the rate of change of dollar accumulation, the rate of change of inflation, the rate of their borrow rate will be dependent on all those other factors.
Yeah. Okay. All right. Look, we're out of time. Anybody listening to this, if you haven't gone to the Pine Brook Macro Substack, you should. There's a reason why David has grown so many subscribers over the last year, because he's been dead right and he's made people a lot of money. So we'll leave it at that. Thanks, everybody.
All right.
Thank you, David.
Thanks, guys.
Thanks, guys.
Thanks, Drew.
Take care.